On this page, we will review the stock summary, which includes several key metrics that I prefer to analyze. It also features two widely used valuation models, Graham's revised formula and the discounted cash flow model. Additional valuation models will be covered on the next page. What we see in this section is largely consistent performance with relatively low growth rates, which is expected given the size of a company like PG. Profitability remains strong and stable with a slight increase from last year. However, free cash flow growth has been somewhat inconsistent over the past 4 years. Dividend growth has also remained stable at around 5%. Debt increased by 6% from last year and the 5-year change is around the same. Shares outstanding has been decreasing regularly over the last 5 years between 0.5 to 1% every year. The payout ratio has remained consistent over the past 5 years, hovering around the 60% range. Personally, I would prefer a lower payout ratio so that more cash can be allocated to other purposes. However, this is just my opinion. Using Graham's revised formula with EPS growth assumptions of 5, 7, and 12%, the stock almost falls within the ideal price range between 11 and 12%. However, the EPS growth rate in the last 5 years has been between 4 and 5%. I prefer to be more conservative when using growth assumptions, but we used a 12% rate just to illustrate the level of growth required for the stock to reach an ideal price point. When using a DCF calculation with free cash flow growth assumptions of 3, 4, and 5%, the stock falls within the ideal price range in all growth rates. However, free cash flow has been inconsistent over the last 4 years. On this page, we will be looking at a few other valuation models, such as the dividend discount model, the residual income model, and the earnings power value calculation. We will be using these models to value the stock when assuming growth rates of other key fundamentals. Using a DDM calculation with dividend growth assumptions of 3, 4, and 5%, the stock falls within the ideal price range in all scenarios. The positive here is that dividends have grown consistently at around 5% over the past 4 years, although the payout ratio is slightly high. At the current price, the stock appears attractively valued. However, when we increase the expected market return to 15%, the stock falls below the ideal price range. When using a RIM calculation with combinations of EPS and dividend growth assumptions, the stock does not fall within the price range in all instances. That said, the residual income model may not be the most appropriate valuation method for this stock, as it is closely tied to the book value. While book value per share has increased at an average rate of about 4% over the past 4 years, this growth may not fully support the valuation implied by the model. In the EPV calculation, we will use a single net income growth assumption, as this model already relies on several underlying assumptions as highlighted now. Based on the net income growth rate of 3%, the stock does not fall within the ideal price range. This model may not be suitable for all companies, since it may undervalue certain businesses by failing to adequately reflect their underlying business models. If you believe the growth rates could be higher or lower, you can use your own estimates to recalculate the stock's value using any of these valuation models. These models are meant to provide a different perspective, and the results may change depending on your growth assumptions and the information you have about the company. Want to see more videos like this? Please like this video and subscribe to the channel.